Welcome to this explainer. Today, we are completely demystifying the Pakistan Stock Exchange. Look, if you've ever stared at the stock market and just thought it was this chaotic, intimidating wall of flashing red and green numbers, you are absolutely in the right place. We're going on a totally jargon-free, step-by-step journey today. By the end of this, you're going to transition from an absolute novice to a confident investor who understands exactly how the machinery works behind the scenes.
Let's just address the biggest elephant in the room right off the bat. Do you actually need millions to start investing? Because there is this massive, widespread myth out there that the stock market is just an exclusive playground, meant only for the ultra-wealthy, the financial elite, or these massive corporate institutions.
But here is the ultimate reality check: 5,000. That's it. That is the actual, literal minimum amount in Pakistani rupees that you need to open an account and start investing in the PSX. I mean, it proves immediately that this market is incredibly accessible to everyday people. You absolutely do not need a fortune to start building your wealth.
And hey, if you're sitting there sweating about the math or thinking you need some fancy degree in finance, just consider the words of the legendary American investor Peter Lynch. He said if you can add 8 and 8 and get 16, that's the only level of math you need to know. It really is that simple. So I want to reassure you right now, basic addition and subtraction are truly all that's required to navigate this space effectively. Okay, so here's our roadmap for today. We're going to cover the basics of shares, the market ecosystem, how you make money, important dates and rules, and finally, navigating market orders. Let's jump right in.
Section 1. Basics of shares. Understanding the core.
Imagine this guy named Asim. Asim has a wildly successful lemonade stand. He wants to expand his business, maybe buy a few more carts, but he needs cash to do it. So, he decides to list his company publicly on the stock exchange. This is called an IPO, or initial public offering. He offers shares to the public for, let's say, 10 rupees a share. The magic here is that if you buy one, you are now literally a part owner of his business. He uses your money to innovate, and you get a real stake in his future success.
Okay, but what's actually in it for you, right? Well, there are two primary ways you make money from Asim's shares. First up is capital gains. This happens if his lemonade stand becomes super popular, demand rises, and that 10 rupee share you bought goes up in value to 20 rupees. You sell it, and you keep the difference. The second way is through dividends. This is when Asim takes his annual profit and decides to just pay a portion of it directly into your bank account. It's basically your cash cut just for being an owner.
Section 2. Market ecosystem. The playing field. Now, to trade those shares effectively, you kind of need to know the real value of what you're buying. We have face value, which is the original static set price of the share, like that 10 rupees we talked about. Contrast that with market value, which is the current live trading price, based entirely on daily supply and demand. Our sources also note a third metric called book value. Basically, if a company sold off every single asset it owned and paid off every single debt, the cash left over per share, that's the true book value.
So where is all this trading actually happening? The PSX ecosystem has 3 heavy-hitting acronyms you absolutely need to know. First, the PSX itself, the Pakistan Stock Exchange. That's the physical and digital platform where buyers and sellers actually meet. Next is the NCCPL. Think of them as the money handler. They safely and securely clear the funds between parties. And finally, the CDC, or Central Depository Company. Since physical paper shares are pretty much a thing of the past, the CDC acts as your ultimate digital vault, securely storing your digital shares.
Speaking of that vault, you actually have 2 options for your CDC account. A CDC sub-account is managed and controlled through your stockbroker. It's perfectly fine and super convenient for active, daily trading. However, if you plan to buy shares and hold them for years, you absolutely want a CDC investor account. This gives you direct personal control over your assets. It's the safest route because it completely prevents any potential, though rare, broker fraud, since literally no one can touch those shares but you.
Section 3. How you make money, profits, and taxes.
The crucial takeaway here is that becoming an active tax filer literally cuts your tax burden in half. For a filer, capital gains and dividend taxes sit at 15%, whereas a non-filer is hit with a hefty 30% tax rate. That makes a massive difference to your bottom line. But actually, here's an amazing historical rule from our sources. If you're patient and hold a share for over 4 years, you are historically exempt from capital gains tax entirely. You keep all the profit from the price increase. Pretty sweet, right?
Section 4. Important dates and rules. The invisible clock. There is this famous rule in the market called T+2 settlement. When you buy a share, you don't actually get it instantly.
Day 0 is trade day. You click buy and your money is locked. Day 1 is T+1, where all the complex clearing processes by the NCCPL begin. It's only on day 2, or T+2, that the shares finally arrive in your CDC digital vault. So to put that into perspective, if you buy on a Monday, because of all the back-end security verifications, the shares actually belong to you on Wednesday.
Now that T+2 rule makes navigating dividend payouts just a little bit tricky. Let's map it out real quick. Day 0 is the declaration date, when the company announces a dividend. Fast forward to day 16, the record date. This is the day the company checks its books, and you must be on them to get paid. But because of that T+2 delay we just talked about, if you buy on day 15, the ex-dividend date, you are too late. You have to buy before the ex-dividend date, so the T+2 cycle has time to process, placing you officially on the books by the record date. After that, the company enters book closure, locking everything down for 7 to 10 days to distribute the cash.
Section 5. Navigating market orders.
So how do you actually bargain in the stock market? Our sources give this brilliant analogy. Think of it like buying an animal for Eid al-Adha. With a limit order, you are holding firm on your specific exact price. You demand the deal happens at, say, 30 rupees, and you will wait until someone meets your exact price. With a market order, however, you just want the deal done immediately. You bypass all the bargaining and accept the fastest available price right now, whatever the going market rate happens to be in that very microsecond.
But look, the market moves incredibly fast, and yeah, it has risks. That is exactly why you need a stop loss. A stop loss is an automatic order placed in the system to sell your shares if the price drops to a specific point. If you buy a stock at 50 rupees, you might set a stop loss at 45 rupees. If the market suddenly crashes, the system automatically sells your shares at 45, effectively capping your loss and protecting you from a total financial disaster. It's an absolute lifesaver.
You're also inevitably going to hear the term short selling. Basically, this is betting against a company. You borrow shares from your broker, sell them immediately at the high price, hope the company performs terribly so the price drops, and then buy them back cheaper to return them, pocketing the difference. You are literally profiting from failure. However, a massive warning here, short selling is incredibly risky, because if the price goes up instead of down, your losses can be practically limitless. Absolute beginners should stay far, far away from this strategy.
We have covered a lot of ground today, but I really want to conclude this explainer with the ultimate secret to wealth in the stock market. Albert Einstein supposedly called compound interest the 8th wonder of the world. The great Warren Buffett calls it the snowball effect. The secret isn't rapid day trading, no. It's taking those dividends you earn and reinvesting them to buy even more shares of the company. Year after year, those small, consistent investments roll down the hill, gathering more snow, turning into massive, life-changing, long-term wealth. You have the tools, you know the basics, and you know the rules. The only question left is, are you ready to start your snowball?